This is the efforts of Russian government to swallow Belarus as an independent state.
I'll be meeting with President Putin, making it clear that we will not stand by.
China could provide evidence that would be exculpatory here. They've refused to do that.
This is Bloomberg Surveillance, early edition.
Good morning. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller in Berlin with Dani Burger in London. Here's what's coming up on today's program. Stocks edge higher, but it's Memorial Day, so trading is restricted. Global stocks remain near a record as the month comes to a close. There are signs that China's recovery may be leveling out, but the news of the morning really in Beijing is that you can now have 3 children there. Plus, Benjamin Netanyahu's opponents edged closer to ousting the legally embattled Israeli leader amid plans to form a unity coalition. All of that and more coming up. I do want to point out we've got headlines crossing from the OECD right now that are pretty exciting. They're raising their global growth forecast to 5.8%. from 5.6%. Now, they do warn that the global economy is improving in a very uneven way. They say the inflation rise, however, will only be temporary with longer-term upside risk. So, Dani, it does look like we get some positive news on the economy now from the OECD.
Yeah, and it's that K-shaped recovery, that narrative playing out yet again. But, Matt, really, the issue here, though, is that when you look at, for example, what bond markets do, they don't trade in a vacuum. If we have Treasury yields moving higher, you're going to have tightness in other financial conditions. So what do you do if, as the OECD says, the recovery is uneven? How do they battle that? How do central banks play off of each other?
Yeah, no, it's a very difficult issue that they all are forced to deal with, and hopefully this week they'll make it a little easier on each other at the G7 meetings. You mentioned that bonds don't trade in a vacuum. You and I were talking during the break about meme stocks. Do they trade in a vacuum?
Sometimes it feels like it, Matt. I mean, look, let me give you the broad argument for where we theoretically would be with meme stocks. We would have everybody back outside. They're no longer on their computer anymore. So meme stock, that narrative goes away, but it hasn't. AMC trading was absolutely spectacular last week. We had near record volumes. We had record volumes when it came to call options. I mean, it just really begs the question, what's going on here? You know, is this a narrative that's going to last forever, Matt?
Well, AMC to me makes sense because you're going back out into the theaters as the economy reopens. I mean, watching a movie in a theater is one of the main things that I want to do, but I don't want to watch Cruella and I don't want to watch, actually A Quiet Place, A Very Quiet Place, is that what it was called? The John Krasinski movie? That was really good. So I am looking forward to seeing the second one. But, the big blockbusters aren't coming out until November. We're not going to be able to see Tom Cruise or James Bond until basically next winter.
Yeah, just hold up, not leaving until you can go see Top Gun 2. I get it, Matt. I get it. I'm sure a lot of people are doing the same. Let's go ahead, though, and get a quick check on what markets are doing this morning, because while a lot are closed, you have the UK, the U.S. closed. You do have U.S. futures trading. We are seeing slight movement to the upside there, very fractional at this point. When it comes to commodities, you've seen iron ore futures gain pretty strongly today. It's kind of a weird day for commodities because we also have LME closed as well, with the rest of London closed. But still, there's enough out there that we have seen a lot of the European sector when it comes to materials move higher as well. Now, China data has been really important for markets as well so far this morning, and we did see a gauge of China's manufacturing industry come in as little changed in May. But at the same time, we had soaring input prices, and that weighed on smaller factories. Now, all that data is coming in as Beijing is also signaling its tolerance for the yuan's rally. That tolerance is fading. Now, authorities set the daily fixing at a weaker than expected level, and state-run newspapers have also warned against rapid gains. But if that's not enough news coming out of China, just breaking this morning, we also had China allowing all couples to have a third child. This is in a bid to arrest an aging population and shrinking birth rate, and that, of course, has been threatening the country's long-term economic prospects. Let's get the details on all of these stories. Let's bring in Emma O'Brien in Beijing from Bloomberg. Emma, let's go ahead and start with that birth rate story. What exactly is the takeaway here with China allowing couples to have more children?
Well, I think most people acknowledge this is probably not going to have a huge impact. We saw them go from the one-child policy to allowing 2 children back in 2016, and that hasn't had a marked impact on birth rates. In fact, we saw the fewest number of babies born last year in something like 60 years here in China. So I think what it does show is a recognition that there is a demographic crisis looming here, that they do need to do something about what is fast becoming a slowing population rate. We're almost in contraction territory with the slowest rate of increase over the past 5 years since the 1950s in population in China. At the same time as they've signaled that shift to allowing 3 children, they are talking about raising the retirement age, which is quite low here, 50 for women in state jobs and 55 in the private sector. So generally a recognition that they need to do something about the demographics here to keep the economy humming along.
Emma, what about the yuan? I mean, we've been following it very closely over the past weeks, rising to ever higher levels against the dollar. I think it's a 5-year high against a basket of other currencies. Is China going to allow this appreciation to continue?
Well, I guess all the signs at this stage are that they're being cautious about it, and it's a little bit hard to tell how they're going to play this. It is a reflection of the strength of the economy post-COVID. You've got COVID contained here, and so consumption bouncing back at higher levels than ever before, particularly because of travel curbs stopping people from moving around. So it's one we just need to keep an eye on.
All right, Emma O'Brien, thanks very much for joining us on really a range of issues in China, some directly key for markets right now, some much bigger macro issues. Joining us to talk about FX strategy is John Hardy. He's the head of it for Saxo Bank. And let's start where Emma left off there with the yuan. We've been watching these moves incredibly closely. I think the MLive question of the day is, how much room is left in the yuan rally? What do you see, John?
Well, I think there's enough space for it to go another few percent, but you get a pretty clear message when they're already pushing back rhetorically against the pace of the move. You pointed out there was a key high in the official basket that goes back to early 2018. We're right around there, and then before that, that official basket was established when they sort of jiggered their currency policy in 2015 at about 2 or 3% above this current level. So I think they're happy to see it sort of slowly strengthening. It does offset some of the price rises from the commodity prices rising, and they don't need to worry as much about FX strength when there's so much demand feeding through from the rest of the world, from stimulus, et cetera, on the good side. So they're fine right now, but I would not be looking for a sort of a runaway period of yuan strength here.
John, how much of this, though, in terms of the yuan strength recently, is about China versus just weakness in the U.S. dollar?
That's a great question, because previously what you tended to see was the Chinese yuan sort of traded in a range and sort of was moved with sort of weak beta to whatever direction the U.S. dollar was going. And recently we've seen this sort of dollar weakness. That, the dollar's not strong here, but it's not going anywhere. Whereas this is an isolated yuan signal. So that fact is what's been new about this cycle here over the last, especially the last week. And I suspect that's why we're seeing the pushback here. Otherwise, I think they'd be happy to see the yuan stronger versus the dollar if the dollar was broadly weak. But when the dollar stalled out and the yuan is continuing to power forward, that's a bit unusual. So, certainly something we need to track here.
What is your long-term dollar view, John? Longer term.
Long-term, yeah, longer term, especially next year and into next year, definitely lower. I think the next 3 to 6 months, though, is potentially full of pitfalls for traders on both sides. we're dealing with this whole question of the transitoriness or not of inflation and how the Fed navigates that. If it does need to taper, if it does need to indicate that eventually rate hikes come in, the market, is obviously complacent on that front. So rolling out that process could mean a lot of market volatility. That often means a bit of dollar strength. So there could be a period here of turbulence where the dollar sort of manages to make a stand here. But certainly longer term, with the style of stimulus, with the nature of these twin huge external deficits, with the need to address the K-shaped recovery, et cetera, I see the dollar lower longer term for sure.
John, how do you script the yuan with other emerging market currencies, especially ones that are benefiting from this very large commodity rally that we've seen?
Yeah, I mean, the yen space has been very strong. A lot of this is created by the incredible distortions we're seeing in markets from the Fed's really excessive QE here. I think that's part of, strong EM is a part of all that. We're seeing these distortions in the massive reverse repo facility, ridiculously compressed credit spreads, et cetera. With commodities doing well, the emerging market currencies are loving this. But again, if we're looking for a period of turbulence, I would suspect we're going to see some two-way action here in the next 3 to 6 months. Again, during this phase of trying to discover where inflation is. If it's not coming, that's also potentially bad for the economic recovery. But if it is coming and it's not transitory, and the need to react to that could also, again, push back against some of this complacency and lead to market turbulence, which is a bit of a headwind for EM. So risk-reward-wise, I think EM is not in a great place here.
Right, and we'll certainly dig more into that U.S. story soon. John Hardy, Saxo Bank's head of FX strategy, stays with us. And as I was saying, coming up, one of the largest downside misses on record. This Friday's U.S. job report will tell investors if that labor supply crunch was a one-off or something we'll have to live with for months to come. We're going to discuss that next. This is Bloomberg.
Meeting with President Putin in a couple weeks in Geneva, making it clear that we will not stand by and let him abuse those rights.
That was Joe Biden saying he will tell Vladimir Putin the U.S. won't stand by on human rights abuses. The U.S. and Russian presidents are set to meet in Geneva on June 15th and the 16th. Let's go ahead and turn to the U.S., though, and talk about the U.S. labor market. The jobs report due Friday could prove a pivotal moment for investors. That's, of course, after the surprisingly tepid job gains that happened in April. Now, according to a Bloomberg survey, payrolls may have risen by 650,000 in May. That, of course, would be a significant acceleration from the previous very disappointing gain of just 266,000. That month, economists had projected a 1 million hiring spree. It was one of the largest downside misses on record, caught many people, both in the markets and economists, by surprise. Let's get back to John Hardy, Saxo Bank's head of FX strategy. John, with that in mind, already there does seem to be this really big divergence of bets for this Friday. I've seen 350,000, I've seen 1 million. How do you position yourself to gear up for just the big amounts of volatility possible in that number?
Great question. It just seems to me that we've seen the strength, with the opening up, we should be seeing a lot more strength in the services sector. We saw a crazy ISM services reading already for April. I'd expect, things are doing great in the services sector. That's where you see a lot of the jobs coming back, and you have to balance that against two things: the fact that there's still the unemployment benefits available through the beginning of September, but elsewhere we're seeing those benefits being cut off by states that believe that it's encouraging people to not get out and seek work. So, I would lean a little bit towards the positive side on payrolls, but the question to me is still that the market knows that we've sort of seen peak stimulus, and do we see the catch-on effects? Or do we see a slowdown after the stimulus has peaked and into the fall? And I think regardless of what payrolls are, it's a bit of a lagging indicator. So there you have it.
Well, what about the Fed's reaction? I mean, at some point, they've got to stop purchases of $120 billion a month, right? At some point, they've got to taper back a little bit as we see this massive economic growth and, very low unemployment. Their mandate isn't going to support what they're doing.
I agree, and we're seeing the first little warnings of that. So we saw Quarles and Clarida last week sort of indicating, the time is ripe at some point in coming meetings to talk about taper, and especially the MBS side. I think that's the easy one for them to begin tapering purchases of MBS when the U.S. housing market is going wild. But it's very clear that the size of this Fed QE is creating all kinds of distortions, and they're having to sort of lend back out all the treasuries that they're buying. It's it's a bit absurd, really. But then at the same time, the question further down the line, once the Treasury has run down its reserves and is needing to up its issuance, do we get a policy mistake that they cut off the QE just when actually the Treasury is issuing more, and then we have that situation in the fall, and suddenly it puts pressure on longer interest rates. It's a big conundrum. I don't envy the Fed's position here and how they're going to be rolling out this message. I think it'll be a very difficult process. But certainly the June FOMC meeting is very much in play for providing some kind of forward hints, as gentle as they may be.
John, do you think the Fed then is willing to maybe see the end of some of the distortions, as you say, created by QE?
I think they would be happy to. It doesn't really help to have this reverse repo facility ballooning up to what it is. It doesn't necessarily help further down the line if credit spreads become so compressed and the reach for yield becomes so dramatic that it creates its own financial stability risks down the road. All these things that the Fed creating its own sort of batch of problems for the longer run by having provided excess accommodation, especially if inflation proves not to be transitory and they have to do an about face on rates and a much earlier set of rate hikes than they're anticipating at this point in time.
All right, John, thanks so much for joining us. Really appreciate your insight today. John Hardy is the head of FX strategy at Saxo Bank in Copenhagen. Coming up, Israel could have its first new prime minister in 12 years. Benjamin Netanyahu's rule is under threat as his opponents move closer to a deal that would oust him from power. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Matt Miller in Berlin with Dani Burger in London. Now, Israeli PM Benjamin Netanyahu's rule is under threat as his opponents move closer to a deal that would oust him from power after years of inconclusive elections. Rival parties are planning a coalition which, although unprecedented, if it works, could form a ruling government. Joining us now is Bloomberg's Simone Foxman. So, Simone, it's shocking, really, the shape this coalition could take. You could have, right-wing politicians joining up with an Arab party.
Yeah, that's right. And it's not just a fractured party with many disagreements. It's also one that would have an extremely narrow majority should it go through. Just 61 seats out of the 120 seats in the Knesset. Now, the differences between these parties are apparent even in the major key players here. One of them is Naftali Bennett. Though his party, Yamina, is a right-wing party, won just 7 seats in March's elections. He does seem to be the spoiler here. He's a former ally of Prime Minister Benjamin Netanyahu, and he's very right-wing, pro-settler group. Yair Lapid is also important. While Naftali Bennett would be the first prime minister for 2 years, Yair Lapid, who actually won more votes in the election, would be prime minister next, but be foreign minister in the interim time. He's more centrist, and he's really been the architect of this coalition, bringing on some of the farther left groups, the labor groups, Meretz. Also, an Islamist Arab party needed to go along with this coalition. Though they just won 4 seats in that election, they're kind of the decider here, and everyone's waiting to see exactly how they turn out.
Simone, how would this impact the government's approach to Israeli-Palestinian relations?
Well, you know, the reason they might join a coalition to begin with would be to advocate for rights, for particularly lifestyles for more conservative Arabs living in Israeli territories, also money for Arab-dominated cities in Israel's north. But generally, when you look across the board of who is in this government, the security cabinet likely to be right-wing, according to reports we're seeing from the Israeli press, and therefore not necessarily a huge difference from what we saw under Netanyahu.
Right, right. Simone, thank you so much. Our thanks to Bloomberg's Simone Foxman. Now, coming up, we get first quarter GDP for India later. We'll discuss the economy as the country grapples with a second wave. This is Bloomberg. Stocks edge higher, but it's Memorial Day, so trading, of course, is restricted. Global stocks remain near a record as the month comes to a close. There are signs China's recovery may be leveling out, but the news of the morning is Beijing, of course, their plans to allow all couples to have a third child. And Benjamin Netanyahu's opponents edged closer to ousting the legally embattled Israeli leader amid plans to form a unity coalition. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Dani Burger here in London with Matt Miller in Berlin. Matt, that China story definitely catching our attention this morning with them allowing couples to have a third child. But part of the question, I think, is also just how much of an impact it will have. People already having less children, not just in China, but throughout the world. And they've enacted a policy going from one child to two children. And that in itself didn't really seem to have much of a difference when they did it at the time.
No, you've definitely hit on the key issue here. I will point out also that the story is fascinating not only to us, but to Bloomberg clients. It quickly became the most read story on the terminal. It's got far-reaching implications if only people would have the amount of children they were allowed to. They're already allowed to have two, as you point out. They're not even doing that. Just relaxing the regulations isn't going to spur them to decide to change their family planning and all of a sudden have three. And these aren't issues that only China faces. It's a real problem in Russia. It's a real problem in other economies around the world. There just isn't that push to have big families. It's no longer en vogue. The current, millennials and Gen Z, they're just not doing it. And as a result, it leaves countries, it leaves economies with a huge elderly population and no one to support them.
Yeah, but I guess one of kind of the quick fixes here, I mean, if it can be considered a quick fix, maybe relatively, is immigration, right? If you need a bigger labor force, you let more people into the country. There was also a headline out of the U.S. about relaxing some of those immigration policies as well. Maybe we'll see Europe follow suit. Places that, of course, don't have children, these types of policies coming out of China, that's certainly a lever that they could press as well.
Spoken like a true economist, Dani. 100% what we hear from guests, 100% what I hear from, economists and government ministers that I speak to on a regular basis. The problem is, with an influx in immigration, you often have a spike in xenophobia. People don't like it when people from other countries come in and start to take jobs. A lot of times they work harder than the people who already live in that country and are resting on their laurels, and it causes huge social problems in some cases, right? That's the issue that we're likely to see if you have increased immigration in the U.S., although hopefully not. Let's take a quick look at what's going on with the data right now. In terms of the trade, as Dani pointed out, you've got a couple of big markets closed, or the UK market is closed. The U.S. market isn't going to open because of the Memorial Day holiday. So you'll see lower volumes, and you may see also less direction. Sometimes lower volumes means more volatility, but sometimes, as Simon Flint has told us over the past couple of hours, it means less movement. Here you see right at the top, iron ore futures up 5.3% in Singapore. So the commodity story continues to be one of gains. I noticed a second ago that we have Brent crude up more than 1% as well. So things that people need to live or to manufacture in a lot of cases are just getting more expensive, and they're going to have to try and pass those costs on. The question is that going to be transitory? The stock 600 is little changed right now, but we do have some fluctuations in European markets with the DAX falling and the CAC 40 rising. So you do see a little bit of volatility here if you look at it on a national level. 10-year bond futures down a little bit. You could see yields rise when they open up for the live trade, and S&P futures are up a little bit. So maybe you see a little bit of growth there on Tuesday when they open for the first time. India looks set to grow at the world's fastest rate despite a devastating COVID-19 outbreak. A Bloomberg News survey says the South Asian economy is on track to grow 10% in the year that began on April 1st. That's even after several economists downgraded their forecast in recent weeks. Very few doubt India's strong potential to pull off, though, such a fast-paced rebound. Joining us now from New Delhi is Bloomberg's South Asia Economy and Government reporter Vrishti Beniwal. Vrishti, why would economists be cutting their expectations when we see the reopening around the world and the strength that it's showing? And now you look at an India economy that just starts on April 1st, right? It's not like the year starting January, so you've got so much more time for the rebound.
So first, I'll talk about the data which is expected today. That is for, January-March quarter. So it's backward-looking data, and that might show you that the economy is recovering. It is exiting the recession that we saw last year after seeing a second consecutive quarter of expansion. But we should not forget that this data is for the period when a second wave of coronavirus infections hit India. It's data before that, and that's why we are seeing an expansion. It will reflect all the demand that was coming back when people were buying everything from mobile phones to cars, and that boosted consumption in India's economy after the world's biggest lockdown last year. Coming back to, how the economy is doing now and why these economists are cutting their forecast, that's because of the second wave. No one saw this coming in India. The government didn't see this coming. So there has been, a sharp increase in the number of cases and the number of deaths we are seeing in India, and that is why economists are lowering their forecast for the year.
Obviously, the government is in a very difficult situation here when it comes to possible restrictions to help curb growth in cases versus trying to revive demand after lockdowns. What do we see the government doing at this moment? So we have seen many state governments in India going for lockdowns this time. The federal government didn't do that. Prime Minister Modi said we are not going for a national lockdown like last year. But state governments had to do it. They didn't have an option when the cases started rising. And as far as, the measures are concerned, those are expected from the central government. Finance Minister Nirmala Sitharaman, in an interview to a newspaper today, said she is open to taking more measures if needed. On the weekend, we saw some measures coming from the government and from the banks where, they have extended an emergency credit program to airlines and hospitals, which was one of the most badly affected segments because of the rise in infections. So more measures could be expected, but having said that, the government doesn't have too much of a room to give a fiscal stimulus after they gave a big stimulus last year. Then there is central banks which could be taking some measures, and it has done so far. It has taken a lot of measures so far in the last 1 year, be it lowering rates
or providing liquidity. But now, because of rising inflation, even the central bank doesn't have much room. It's expected to decide on monetary policy later this week, and we are expecting a status quo as far as interest rates are concerned.
All right, well, we'll certainly keep an eye out for that GDP data at 1 p.m. UK time. Frischie, thank you so much. Frischie Benewal, Bloomberg South Asia economic and government reporter. Let's see what else is on the move today. Let's go ahead and go to the Bloomberg First Word News with Laura Wright. Good morning, Laura.
Thanks, Dani. President Joe Biden is pledging to raise the issue of human rights during his meeting with Russian President Vladimir Putin next month. The leaders are set to meet at a fraught time for relations between the two sides. The U.S. has blamed Russian-based hackers for recent cyber attacks, but Biden stopped short of directly implicating the Kremlin. Opponents of Israeli Prime Minister Benjamin Netanyahu are moving closer to ousting him. Former ally turned rival Naftali Bennett is working with an ex-finance minister to unseat the nation's longest-serving premier. It comes after 4 elections in around 2 years failed to break the deadlock in Israeli politics. U.S. experts are warning the world has to find the origins of the COVID-19 pandemic to help prevent future pandemics. The precise origins of the virus remain unclear. Scientists say it most likely spread from wild animals to humans, but the theory it escaped from a research lab is gaining traction.
The side of the ledger that suggests that this could have come out of a lab has continued to expand. And the side of the ledger that suggests that this could have come from a zoonotic source, come out of nature, really hasn't budged. China could provide evidence that would be exculpatory here. They could provide the blood samples from those who worked in the lab in Wuhan. They've refused to do that.
Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Matt, Dani.
Laura, thanks very much. Laura right there with your First Word News. Now coming up, the summer season looms large as economies begin opening up. International travel looks set to get a big boost. Bloomberg's Simone Foxman caught up with Qatar Airways CEO Akbar Al-Bakr and got his views on the state of aviation. We'll have that exciting interview next. This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Dani Burger in London with Matt Miller in Berlin. Now, Qatar Airways CEO Akbar Al-Bakr has lashed out at Airbus for the second time this month, this time warning his airline might stop taking deliveries from the French plane maker this year over an unspecified serious issue. Those cryptic comments came during an exclusive interview with Bloomberg's Simone Foxman.
We are a state-owned company. Our government injected $3 billion into our equity.
$3 billion.
$3 billion because we were burning cash. But keep in mind that there is not a single airline in the world who has not gone to their government for help. But they have gone for their government for help.
You went to Airbus and Boeing and asked for deferred deliveries of various aircraft. Are you taking any deliveries this year?
Yes, we are. We are taking deliveries from Boeing, and we are earmarked to take deliveries from Airbus. We have an issue with Airbus that we need to settle, and if we are not able to settle that serious issue we have with them, we will refuse to take any aircraft from them until our issues with them is resolved.
Okay, so which aircraft?
I unfortunately cannot tell you what that issue is, but it is a serious issue which we need them to address, or Qatar Airways will not take any deliveries from them.
Does it have to do with the A380s?
No, that has nothing to do with relation with Airbus. That is already for us water under the bridge. What is important for us is our future relationship with them. They need to know that we are a very serious and a very important player. They should know that affecting our relationship with them will cause them a stress in the relationship with IAG, with LATAM, with other airlines in which we have shareholding.
Let's talk Boeing. The 777X is hotly anticipated. You said you're not going to be the launch customer.
We are the launch customer.
You are the launch customer?
Yes.
Okay.
And we are looking forward to receiving them.
What's the timing exactly?
Boeing has delayed the deliveries until 2023.
Okay.
And we are fine. If they can deliver it to us in 2022, we will accept them.
Okay.
The only problem we have is there is a stress in the supply chain for the entire aviation industry. And I hope that that will be resolved by the time we are due to receive our 777X.
Emirates' Tim Clark has bashed the 777X. What's his why?
He has his opinions. I have mine. And I think my opinion in the industry matters more than his opinion. I'm still not due to retire.
What is your outlook in terms of M&A over the next 18, 24 months? When do you think it will be a good time, perhaps?
It is difficult to say because there is no resolution to the pandemic. You know, there are waves and waves of infections happening. There are spikes in certain regions. You know, Australia thought that they had completely eradicated, and now suddenly Melbourne is under lockdown. So it is so, what is the right word, unpredictable, that we don't know how to plan what we will do from year to next.
And that was Qatar Airways CEO Akbar Al-Bakr speaking exclusively to Simone Foxman. Al-Bakr and other key figures in the airline industry, maybe not as key as Al-Bakr, will tell us more about what the aviation players can expect at the Qatar Economic Forum, powered by Bloomberg. The three-day virtual event will feature heads of state and top CEOs from around the world. It kicks off on June 21st, so make sure you stay tuned for coverage. Now, oil is advancing with the market focused on an OPEC Plus supply policy meeting earlier this week. And any commentary around the prospect for returning Iranian supply will be key to watch for. Joining us to discuss is Bloomberg's Anthony DiPaola. Anthony, set us up with what we should be expecting from this meeting.
Hi, good morning, good afternoon, Matt. The expectation is that OPEC Plus will continue with their policy of easing oil back into the market. They had decided to add about 2 million barrels back into the market over a period of months. So they've got something a little bit shy of 1 million barrels that they plan to start adding back in July. And the expectation is that they will continue to move ahead with this, that there aren't any reasons out there in terms of pandemic issues or other lockdowns that would stop them from doing that. What will be interesting to see is their outlook going forward. Beyond that July increase, they do have plans to bring the rest of the crude oil that they took off the market in the wake of the pandemic back to customers. So we'll want to see what is the schedule for them bringing that oil back to the market and how they see oil in the second half, whether they see enough demand, how they're going to react to the potential return of Iran. These are the issues that we'll be watching for, Matt.
Anthony, do those stunning defeats from Exxon, Shell, Chevron last week in terms of pulling back on fossil fuel, does that change the calculus at all here?
The OPEC countries have for a while now been talking about lack of investment in oil. And for their part, many of those OPEC countries, the richer ones here where I'm sitting in Saudi Arabia and the UAE, they are going ahead with investment and putting up some big numbers to keep their fields going. So there's kind of two stories there. The international oil companies having to pull back on exploration budgets because of climate change issues, because of the drop in demand, whereas the national oil companies here are seeing the market window for them selling their oil, they're seeing that narrow, really, as the globe transitions to a cleaner economy. So they want to continue investing, get that oil out of the ground and sell it. So that does create some opportunity for them. And a lot of the analysis points to a tightness in the market towards the middle of this decade, which might be an opportunity for them, Dani.
Anthony, I'm afraid we're going to have to leave it there. Thanks so much to Bloomberg's Anthony DiPaolo. I also want to give us a quick headline that's just crossing the terminal. China PBOC raising Forex reserve requirement ratio by 2 percentage points. This, of course, is going to impact the yuan that's been strengthening, something China has been trying to combat. The gut punch reaction here does seem to be one of a weaker yuan, trading around 6.36 when it comes to the offshore at the moment. That's what you're looking at on your screen. So a development we'll keep watching along with all the other headlines coming out of China. Also going to talk about coming up after one of the largest downside misses on record. This Friday's U.S. jobs report will tell investors if the labor supply crunch was a one-off, or is it something we're going to have to live with for months to come? We're going to discuss the week ahead next. This is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Dani Burger in London. Now, we just got some big news out of the PBOC. They are raising the Forex exchange, the foreign exchange reserve requirement ratio, the RRR, by 2 percentage points to 7%, Dani. Now, this is, you know, the kind of thing that's aimed at strengthening liquidity management for financial institutions, and really, as you pointed out, trying to combat the strength that we've seen in the yuan. You can see here the initial reaction is a little bit of a weakening, but not too much, from 63.5 to 63.6. And we're talking about a yuan, a Chinese currency that's at a 5-year high against a basket of other currencies. It's at a multi-year high against the U.S. dollar. So it looks like they're really going to try and take some decisive action to stop the gains.
Right. And you know, when we were talking to John Hardy earlier, he was saying, look, a lot of this is about the dollar. So it's kind of a question as to how much impact can China have, especially considering they were having less of an interventionist type approach. Well, here we clearly see, at least slightly, they can have an impact.
Yeah, absolutely. So it'll be fascinating to watch. The dollar side, of course, is one that we are very focused on as well. Let's take a look at your week ahead. What should you be watching? OPEC Plus countries meet tomorrow to review their oil production plans. And this could be the big one, folks, after a couple of canceled meetings. Keep an eye out for also a policy decision from the Reserve Bank of Australia. Wednesday sees the start of the St. Petersburg International Economic Forum's PEEF. Jumping ahead to Friday, the G7 finance ministers and central bank chiefs will meet in London. Also watch out for a rate decision from India's central bank. And if you feel like it, check out the jobs number as well. Plenty more to come from our Memorial Day coverage. This is Bloomberg.